Well, it's always good to be here. And yes, this is a very timely discussion. So really appreciate the opportunity to be able to share with the members on this. And we'll send a recording. I'll have it posted either on your YouTube or our YouTube channel too, because it's a fundamental question that people want to have, to be fair, whether you're in a situation of owning a home and maybe some planning as you're considering to sell maybe this year or over the next few years, or if you're renting a place and you have the question, should I keep renting or should we be thinking about buying? At the end of the day, it's your own individual decision to make. I'm here just to give you as much information as possible, and I'm also happy to answer any questions that you guys may have as we go through this. So let's share a little bit about myself. It's extremely important to have perspective of the guest and the individual because a lot of these insights are not felt the same way. But given the volume that I do and given how much I track the market every week through my public reports, I get to see a lot of the things that are happening. Now, I don't predict the future, so that's very important to understand. I'm not predicting anything, but I'm also giving people the general probability and general state of things, and people will make their own decisions from there, right? So a little bit about so I'm born and raised in the Bay Area. I've been a lifelong resident. Some people have moved to Texas. I'm not going there anytime soon. A little bit about myself. I bought a Model 3 back in 2019. Give you an idea how many miles I've driven in the Bay Area. This is all local driving. Drove 73,000 miles so far. So that's equivalent to like 25,000 miles a year. So I'm just all over the Bay Area. So I go all over and I track and know what's happening all over. My background, I first got into the industry of sales and business development through technology. So I was in software sales and eventually became a manager over my first decade of my career. And then I transitioned into owning my own business. And, myself and my wife, who's a lender, she's not here today, are the proud sponsors of being the real estate and lending team for Tesla of Silicon Valley. So a little bit about production, because that matters, because the conversation really has to do with, okay, well, yeah, you're going to hear all sorts of things, whether it's from the media, from your friends that may be realtors, but at the end of the day, the opinions, and hopefully as you start seeing the data points yourself, the conversation and the strategies are all really relevant to who really is the one that shares this information and gives you that feedback. So for myself, last year, I'm very fortunate. I was awarded to be in the top 1% in the country by helping about 58 clients, which is 73 million production. And then this year so far, we're going to outdo that as we've already helped 52 clients so far in the beginning of August. So what is the situation, right? What in the world is going on? There's a lot of things that have happened now. And it's also important to have a snapshot, because I can really paint a very bad picture if I wanted to. I could paint a very positive picture if I wanted to. But a lot of these things are still moving, and that's the interesting part about this all, right? It's still fluid. So history, the situation, interest rates are up from a few months ago, right? However, interest rates are not at the highest that it has been all year. A lot of people may think that if they're not kind of following and keeping track of like what mortgage rates are doing. But quite frankly, interest rates have actually declined since the end of June. A lot of people didn't know that because they assumed that just because the federal fund rate has increased, that because the federal fund rate has increased, that would automatically impact the mortgage rate, that's not how it works. There are some other news, right? GDP has decreased for 2 straight quarters. From all of the textbooks and everything that we've known, that usually means recession. But for whatever reason, in this political climate, they are not saying it's a recession. They're saying we need to think about it, or we need to have somebody else tell us this. From that perspective, we're probably in a recession. We are likely in a recession. Now, there's a difference of something being very catastrophic, like it was in 2008, versus something that could be fairly mild. Nobody will know how long it is until we're actually out of it. So that's I'm not trying to predict what that'll be, but I'll actually have a quick clip in a moment of what Elon Musk thinks about how long this recession may last and how long inflation may last. The Fed continues to increase its baseline interest rate. Now, to be fair, the next rate increase or the next decision to potentially increase the rates are going to be out in the September meeting. There is no August meeting. So that's why you also see like this kind of rebound that's happening when it comes to stocks. It's going to be kind of quiet for some time. Tech stocks are down from a few months ago. I mean, if you're investing in high growth stocks, I mean, you probably got decimated on that. But even the big tech companies have also been impacted. But that being said, if you actually look at the charts, look at Tesla stock, they've actually recovered quite a bit, and not a lot of people are tracking that because it's been about 4 weeks of continued growth of stocks in their portfolios. And the last situation is that inflation is still high. Now, the good news is that we have declined from some of the highest we have been. So the previous month was at 9.1%. This last reading was like 8 point something, mid eights. So there are some signs there, which are all positive news. So interest rates, right? What has been going on with interest rates, and why did things change so abruptly? In the beginning of the year, we had the hottest real estate market in a long, long time, arguably in the last 10 years. Why was that happening, right? You had inflation that was creeping up. You had the notion that people were, that prices were rising very quickly. So there's a lot of people had FOMO to enter in the market. So you had a lot of these pressures that naturally happen to really drive up prices. But then, things took a drastic turn because as soon as interest rates were being driven up, as you can see very, very quickly, right? There was no forecast that we were going to have rates at this level. Most of the forecasts, if you ask people and you look back in news articles in the beginning of the year, they're closer to maybe at 4% for the end of the year. But things shot up very quickly. At the worst of times, it shot up to about 5.7, 5.8%. And this is a matter of like 3-4 months. And that's why it's been such a drastic impact and this rebalancing that has to occur for all sorts of different assets, right? I mean, you saw what happened with growth stocks. You now see what's happening with valuations of private companies. There's no mistake in why there's layoffs across the board amongst these companies that were just not profitable because their valuation and their expectations is completely cut. But then you also look at the impact that it also has on all sorts of different assets, crypto, other stocks that are actually have a lot of earnings, and certainly real estate. And so you see that happening, and there's been a drastic change. So people's affordability is completely different, right? If someone was able to afford $1 million as a hypothetical at 3%, they're not going to be able to afford the $1 million at 5%, right? Their affordability maybe have dropped by 20%. And that's why we see these things happen and these adjustments. So there's obviously been a very aggressive increase over the last couple of months. The good news is that, as I mentioned, the last couple of weeks and really since the end of June, things have declined. And my suspicion is that they'll probably be around this level for a while, which is good and bad. It's good in the sense that people at least have a footing to reassess their situation on versus like that kind of steep increase. But of course, time will tell. Next, GDP has certainly been impacted, right? So in more detail, GDP has shrunk for the last 2 quarters. Traditional measure, this is a recession. Consumer spending is down. The question ultimately people will have is buying a house a good idea during this time? And we're going to cover a lot of that later on. So the Fed and inflation. So the Fed increases rates very aggressively throughout the months, right? There was a 75 basis point increase in the last meeting that they had. I suspect that this will keep probably happening unless inflation gets tamed, because we still have very high inflation. And so always a fundamental question is, are we already past a peak? Have things started to drop down? Right? These are all questions that people want to ask. But I think it will be a good opportunity right now too, is just to listen to see what Elon has had. Because Elon actually shared, and I shared this in one of my other videos during his shareholder event just like 2 weeks ago in Austin. He made a comment about this because as he runs this massive business and he has supplies and he's also doing the forecast of how the company will outlook, but also he gets a lot of this intel in advance because all of the financial planning is through it. So I'm going to show this little quick clip, if you don't mind, because it'll just be good to listen to hear his perspective, and then we'll come back into the slides. So let me.
Bracket.
You have to purchase commodities many months in advance of when they're needed. Like, so you need to tell, because it's a very long supply chain with a tremendous amount of inertia. So we sort of have some insight into where prices are headed over time. And the interesting thing that we're seeing now is that most of our commodities, most of the things that go into a Tesla, not all, but more than half, the prices are trending down in 6 months. 6 months from now, this could change, obviously, but the trend is down, which suggests that we are past peak inflation. Making macroeconomic prognostications is a recipe for disaster, but my guess is that we're past peak inflation, and that we will have a recession. I think it will be a relatively mild recession, sort of. I'm just guessing here. It was total speculation, but I would guess it's a mild recession for 18 months or something like that. Would be my best guess right now. We don't have fundamental capital misallocations in the U.S. as we have had in the past, like leading up to 2008, where we were building primary housing units at twice the rate of household formation, which obviously doesn't make sense. And there were a lot of companies that were over-levered. The leverage or debt that companies have right now is relatively low. So, yeah, I would say probably mild, moderate recession, maybe 18 months ish, and I think inflation is going to drop rapidly. That's my guess. I don't know. What do you guys think?
Yeah, so as you can see, that's his thought. He made it very public in the last shareholder meeting, which was just 2 weeks ago. So, and like I said, he's doing his entire business planning according to that, right? And so those are all good signs, and it's very likely to happen. Of course, there's always uncertainties, but that's the general trend of where things are going, which is not what's usually being reported if you just look at the bunch of media outlets out there. So let's take a look at just kind of tech stock performances. As I mentioned, if you haven't been seeing this, you may have been asking, okay, wow, yeah, tech stocks, I remember they declined a lot. And the reality is, yes, a lot of the high growth ones have not done well. There are some businesses that are just not doing well versus others. But also, to be fair, if you actually track and see how things have progressed, a lot of also other companies, you look at NASDAQ as an index, you look at Tesla itself, a lot are creeping up towards the previous highs that they have had. So those are always good positive signs, but we may see, I don't think it's going to be unrealistic to see those growth companies, those startups that have raised a lot of money that aren't making any money. They may have had a faulty business model to begin with. They're going to keep having pretty massive layoffs. I don't think there's any shock of that. But for these bigger tech companies, a lot have actually recovered and done fairly well. So how does this impact U.S. housing? And so you're going to see, I'm going to show you what's happening on a macro level, which is kind of around the country. But at the end of the day, the impact is always regional. So that's one aspect. The other aspect is impacted by prices. So for example, if you're a first-time buyer or you're quote unquote an average buyer in the Bay Area, that's a category. And then we can look at homes that are, let's say, double the median price. So more luxury, you can see what has been going on with there. And I have stories and I have examples given. Personally, I deal with this. At the same time, you can see from the data yourself and you can give your thoughts and your conclusions. But across the board, especially in the Bay Area, because the Bay Area is more tied to tech, there's been a bigger decline in prices more than others. You might be surprised. A lot of other areas haven't actually had a big decline at the moment because several things, right? Tech companies have been impacted, combination of their valuations have been slashed. So the amount of money that they can have from their equity and their RSUs are different. Mortgage payments are higher. There's certainly the confidence level. And so you have and also just generally a lower affordability, right? Because if rates have increased 2%, that's equivalent about, let's say 18 to 20% of your affordability of what you could have bought before. But prices haven't declined by 20%, right? So it's not balanced out. And so unless it gets to that point, the affordability index is just going to get worse, right? And that's the case. It's been some of the lowest affordability levels, I think, in the last few decades, was a recent report. But at the end of the day, too, those are all the bad news and the bad signals. At the same time, it's not all bad, right? Take a look at this, right? Interest rates have already declined since a month ago. The US continues to have still very strong job figures. So that has continued to do well. Unemployment continues to decline. So it's at lower than 3.5%. So there's a lot of still positive news of the general sector. And to be fair, there's also more opportunities now that people may have. So for example, a lot of clients are first-time buyers. They can buy with little money down, which wasn't even an available option before, because you would have just got, your terms weren't strong enough. So a lot of people that are VAs using a physician loan, using a FHA loan, right, from 0%, 3.5%, these kind of 10% down options, they're considered strong because they're maybe the only buyer that's out there. You may be able to have contingencies again, right? So at the end of the day, as the market shifts or the market changes, there's just a different game plan that is there for that specific situation. The other troubling news, though, as you can see, is evidently, and anybody that's in the Bay Area, never mind if you're in the other parts of the country, rents have continued to increase, right? Because imagine this, those people that were going to be buying a house are not buying a house now. They still have the money because they were able to have the money to buy a house. So now they're instead going back into the rental market. And that has impacted a lot of people. And so generally rents are significantly higher this year than the previous years. Now, I'm going to share two sides of this. And at the end of the day, I'm going to share, if you're a buyer, what should you be thinking? If you're a seller, what should you be thinking? It's a tale of two sides, and you will see from the data itself. We're going to first talk about if you were a quote unquote, someone in the median price range of an area. As you can see, the median price range of a home in between single family condos and townhomes in Santa Clara County is a little bit over 1.4. So let's say that's kind of one demographic, and the other we'll talk about is those that are considered more of the luxury market, let's say 3 million plus, and see how that has played out. So from most people, these are become first-time buyers, or they could be upgraded individual, like people that are upgrading and upsizing. You can see the general trends, right? So April and May was some of the hottest it has been. It has been a pretty strong increase since from the beginning of the year. But you can see it's been a pretty drastic decline from then too. I would say from personal experience, a 10% decline in the last 2-3 months is not unexpected. If you look at inventory, what has happened there? You can see typically inventory has been very low for a long time. Inventory simply means if there was no new homes coming on the market, how long would it take for all those homes to be taken off and there's nothing to buy left given the current velocity? And you can see, because there's just less people buying, then you see these levels creep up. Next, days on market. Days on market are also longer. Now, it's not like, I think it's also important to understand, like, this is now 2 weeks on average it takes to sell. Before, for a long time, it's been under 10 days. Most of the time it's been under a week. Now, what happens in this situation is that good homes are still moving very quickly. The ones that are sitting longer are those that require a little bit more work, or the ones that require a lot of work. Buyers can have more options now. So instead of them just buying a home that requires work and putting in their own time and money to do it, they may elect to just wait and look at a newly remodeled one or more remodeled one and just buy that instead. So if you actually break it down, it's still moving fairly quickly, depending on someone's perspective, but it has slowed down. The interesting impact too, though, is new listings are down. So it isn't a situation where people are like crawling back into wanting to sell their house before the prices decline, because people have tremendous equity in their homes and their rates are very low, right? Most people, hopefully you guys all refinance if you own a home at least once or twice during the last few years. So you have a very low rate that may never be that number again. And so it's also a difficult situation for people that are homeowners, even if they're wanting to move somewhere else or to do a trade up it's like their cost is going to be significantly higher. And so that's a major problem that we will continue to see, is they have to have a very strong motivation to want to / need to leave for them to consider to even think about selling their house. So you can see the new listing count is down. Now, there are seasonalities, so I'm not saying there's no seasonality impact, but that's also an important factor. And the last but not least, these are usually very good leading indicators, which is how many are actually going contingent and pending, not necessarily being sold in a specific month. So these are the ones in contract. And you can see the numbers have declined month over month from April and May to where we're at today. So you can see the decline. So this is the situation if you're in that category. Some of you are, some of you are not. But what if you're on the higher income side and you're buying a $3 million plus house? It's also important to understand it's not equal. Now, what's interesting when you look at this, though, is they didn't actually go like just the general market had increased, but this category didn't actually have a very big run up during the up times. Why is that? From what I've seen personally is people that have higher incomes, especially in the Bay Area, and they're working in tech, they may have not even bought in the Bay Area. They may end up buying somewhere else, Miami, New York, right? These other Southern California, those areas have done extremely well in the luxury market. But in the Bay Area, given the Bay Area, that wasn't necessarily the case. And so what's interesting is they didn't actually have this luxury rush of people. It's just been fairly consistent. But we also see now is because it didn't have that big pickup, it's not like it declined the same percent either. So just something very important to understand, depending on which category you're in and which areas that you live in, it's not the same story that is in place. So just very, very good, important details to note. If you look at new listings, it's much more drastic, right? Same idea. They're even less under pressure to sell. So hence now you have really low new ones trying to even hit the market. Very important to keep in mind. But you can see there's not a whole lot of activity also going either on the contingent pending side. It's been a very big drop off. So a lot of information to digest, right? And that's a lot of the data points that I wanted to share with you all so that you can clearly see it. Everything that you see here will be seen much further in advance than all the news outlets that you will see online. Why is that? All of this is real time. All of this is pulled as of yesterday. All the news outlets that you will see is data pulled from a month, if not 2 months ago. And that's why there'll be a lot coming up, because a lot of the figures that you will see is going to look very dim for the August reports, right? Because the August reports are going to be pulling the data from July, right? If you're in contract in July, it will close in August. So my guess is that the August figures will look very bad. It will look worse than what they have here. But there is some light out of the tunnel, is what I personally see myself as people have come back from vacations and traveling in record numbers. So the decision for people is this: how long do they plan to be in the Bay Area? That's the fundamental question that I ask anybody, whether you're a buyer or you're a seller, right? And that's a very important thing. And we're going to show you why that's such an important metric. If you are unsure if you're going to be in the Bay Area and you're going to be gone in a year, maybe you want to move to New York, SoCal, Seattle, Florida, Texas, wherever it may be, then probably you should not be buying. You're not going to be a good candidate to be buying because your opportunity to flip your house in a year and gain like a sizable profit is probably not there. Whether it goes up or down, it's just a bigger bet to make because of just the reality of it.
No.
And so that's the thought. Now, if your time horizon is for various reasons, whether you like the Bay Area for the community that we have here, the weather is super nice, lots of job opportunities are still here, and you like that atmosphere and you're planning to be here for a few years, then it still makes time to continue to look into and decide if this is the right time for you. Why is that? And why are those important factors? The important factor is if you're not owning a place and you're paying rent, you can see for yourself what has happened with rents. And just do some quick math. I mean, if it's a $3,000 to $4,000 place these days, which is not even that expensive, that's $36,000 to $48,000 a year. That's the cost of just sitting around and banking on prices declining further for you to be able to get in. And so there are a lot of opportunities right now, and that's the game, right? The game is different when you're in a hot market that's rising versus when you're in a down market. The down market game right now is you have a lot less competition, so you're ultimately buying things at a discount. Just because they listed at one price potentially means you can still get it for even below that. Things that have sold in the last few months, you may be able to get it below that too. Those are all good things. Whenever you have a very nice thing, like imagine if you can get a Tesla car at a discount, that's a very positive thing, right? There's nothing wrong with fundamentally that car. When you're doing that, those are very positive things. And housing is many times that same way. So, but people have this kind of FOMO attitude that is in place, and that's their own decision to make, but that's also just important to factor in. So there's a lot less competition right now than before. There's opportunities to buy things at discounts, especially bigger discounts for those who require work. Because what happens in this market, think about this, right? When the market is hot, you have a lot of people actively looking and everybody's actively bidding. The premier properties that are in nice conditions and good locations have a lot of bidders and interest. As those bidders give up on that type of segment of properties, they then go on to the middle ones, maybe those that are updated 10, 15 years ago, or there's something wrong. There's not necessarily wrong, but something minor wrong with it. Or they also go with those that say, you know what, let me buy things that are in bad condition, I'll just renovate it. When things are what they are now, what happens? The buyer pool in the top tier is a lot less. So people then think they just wait and see for that newer property and nicer property and go after that. So what happens to those other ones? They get more overlooked. Some are ready to be moved in still, they just may be older. So what happens right now for those is that you're going to get a bigger spread than you've ever had before for those. So I helped a client buy a house recently in Los Gatos. We bought it for $400,000 below the previous list price. And that was like I think it was like a 12, 13% discount from the initial list price. It required a full remodel work. They're okay to do it. They have the time to do it, right? So the opportunity is there also for those that require more work. That's a part of the strategy of what happens in these markets. Next, consider using an adjustable rate mortgage product instead, right? All the quotes that you're seeing for like the 5% the 5% rates or whatever it may be right now, those tend to be 30-year fixed rates, right? So in the higher interest rate environment like this, and over a long period, there may be some declines. Obviously, you have to make the call yourself, and also how long you want to stay in the property. You can use a product like an adjustable rate mortgage. So your rates are significantly lower than 30-year fixed, but it's still locked over X amount of years, 5 years, 7 years, 10 years, whatever you decide to choose. And then if rates do drop, you can always refinance. That's where you're able to find the house that you like, but then you can shop around with the rates if the rates do drop. And if the rates go up, then you're glad that you got the place with that rate. And also just be mindful of, right? You saw the days to sell on market. Even though the market is slower, it doesn't mean everything is on a standstill. Like we're just like nobody's doing anything. The reality is good homes are still selling, and they're still selling very quickly. They'll still sell within a week very easily because a lot of the people are still waiting for those kind of homes. Now, if you're a seller, what does that mean, right? Seller is completely different because it depends on your time horizon and how long you want to be in the property, right? Like the seller conversation that I have with a lot of people is, what do you plan to do with that equity? And that's a personal decision to make, right? Some people say, look, I can get a whole lot more cash flow and capital and a return on my investment if I buy out of state, or I put it somewhere else, or I just hold it in cash. That's a viable option for individuals. They may just want to have the money saved for a rainy day, because while prices have declined, look at any of your home portfolios and how much your home is worth if you owned it for the last 2-3 years. You're all sitting extremely equity rich right now, and you're obviously hopefully glad that you made that move 3+ years ago. And that's just in the last 3 years. And so a lot of that money is trapped. So a lot of people have to make the decision. What do they want to do with the money? Are there better opportunities? Are they trying to move somewhere else? Even though the market has declined, and that's a hard conversation to have with a lot of people, the reality is most people have a tremendous amount of equity still in their home, and they can do other things. There's also tips to be had, though. As I just explained, The top property that are still moving are those that are remodeled or in good shape. And so if you're planning to sell, you need to think about that as a very strong consideration to put in some work into the house. My team can help you with that, but that's a very important thing to also incorporate to try to get your house into that top tier that people are still actively buying and working with. And lastly, to conclude, who you work with now matters more than everything. Like what I like about this market, which is a much more normalized market, is that the spread that can be had from a seller or from a buyer is now very significant, right? It's not just a blind bid anymore that, oh, you better just pray and put your maximum bid to just have a chance to buy a home, or as a seller, any home that puts on the market will just sell. That is long gone now, right? Now the strategies that are in place for the buyer or seller is the most important time. And so this means that the individual that you trust and work with along with this journey matters way more than at any time. And that's why I personally enjoy it. It's a lot more of a skill-based market that we have now than before. The last thing I'll bring up is maybe you consider still, if now you're buying a primary house in the Bay Area or an upgrade in the Bay Area, you could consider an investment property, right? You can consider other areas, because when you have high inflation, when you also have higher rent growths, like those are still good opportunities because you're locking in your mortgage rates. At the same time, you're still collecting more and more cash. And so these are also really interesting opportunities that a lot of people are still making moves on. Take a look at these recent raises and you will see what is happening, which is always fascinating. Blackstone. If you don't know who Blackstone is the largest real estate and asset fund holder probably in the world, at least certainly in America. And they raised another massive war chest, another $24 billion for its latest real estate fund. What are they buying? What is Blackstone buying? If you don't know, and it's very polarizing, Blackstone has been buying a bunch of single family and apartment complexes in mass, and they're just renting them out for profit. That is the game that has been going on for a long while, if you were familiar with it or not. Here is one that came as of yesterday. Andreessen Horowitz announces plans to invest in, who is this person? The WeWork co-founder, $350 million. I think they changed this now. It was initially 350, let's say it's $325 million for something that's not even public yet. There's no product yet. There's no proof of concept. What did they invest this amount of money, which is the most they have ever cut a check for? They cut a check for adding values to multifamily homes. So multifamily, like apartment complexes. His game plan in theory right now is they're going to create more communal activities, communal engagements, just like they did with WeWork, but now in the residential living space. There's a lot of money still being pumped into this economy from these players. There's a lot of money still buying investment properties, because at the end of the day, you got to look at the total things, right? Housing is still in very short supply. New construction is in a very difficult situation right now. But general over a long period, housing is still in very big short supply. And a sub part of it actually has to do with these players that are outside entrants that are gobbling up and buying these in masses. And so those are opportunities too that one can have. You can either buy individual units, and I have great realtor connections all across the country that I can introduce you to. So that's option one. Option two is potentially you get involved with investing in other projects like other apartments and things like that. The last thing I want to bring up, and I'm happy to open up to any Q&A, and I hope this is all very helpful for everyone that's listening, is also perspective. In the last real estate recession, and this is why time duration, and that's why I brought that up, matters. In the last real estate caused bubble, which is the worst real estate crash in history, home prices, as you can see in San Francisco Bay Area, have declined 27% over the course of 3-4 years. And so what does that mean? It means and that was a real estate caused one with fake products, faulty loans, etc. So it means generally, if you look at that, and this was a real estate caused bubble, people that tend to have been able to withhold it or hold on to it for at least a couple of years, it actually recovered and it did fairly well, obviously, evidently afterwards. That's why it's the mindset of okay, if you're trying to get in this game right now to flip a home, I think that would be very risky. I wouldn't suggest or recommend anything like that. But if you're buying a home for yourself, especially in the Bay Area, or you're able to ride it out for a couple of years, people tend to do very well. I'd love to open up the Q&A, and you can, of course, reach out to me if you want to set up a separate strategy call to go over your specific situation. I do a lot of these webinars all the time. You can also follow me on YouTube. Fortunately, I have over 2,000 subscribers now that listen and watch my content weekly. Or you can also follow me on Instagram. I share what I have of tips and the life of myself through IG. Happy to answer any questions. Otherwise, we will then wrap up and call it. And you guys are all muted. But I think you can unmute yourself if you want to ask anything.
Or you can type your question in chat.
Cool. We'll wait a few minutes for that, and then we'll wrap up if nobody has any questions.
Hey, Spencer, my name is Shashank. I'm really sorry I joined in like pretty late, like last 5 minutes of the presentation. So I don't know if you have already covered this, but my question is, I am I'm one of the there is a meme, right, which says that millennials waiting for the housing market to crash. I'm one of the millennials. So I don't know what is the right time to like enter into this market. Right now, for a while, I collected like a bunch of money, saved money for like the down payment, but now the interest rates are like super high, right? So again, I'm really sorry if you have covered this before, but for someone like me who has like probably some of the amount saved up for the down payment, what would your recommendation be? Is it to like look for properties now in this market and wait for the interest rates to go down later so that you can remortgage it, or wait for again, just like hold off on any big purchases as of now?
Absolutely. So yeah, we spoke about a little bit about this, and a lot of it has to do with time horizon. I mean, that's the answer to this, because if you think you're an excellent market timer, think about your own portfolio over the last year. Did you sell all of your stock at November? Like, ask yourself, like, and I just straight up will ask people this: are you that good of a market timer? Did you sell everything at the high of things? Did you actually enter in back when the things have actually recovered quite a bit over the last 4 weeks? If you didn't have a crystal ball, which nobody has a crystal ball, then it's less about market timing then, because nobody really knows about these weekly, monthly kind of events, right? But what do we know about most people's situation? Most people's situation, if like yourself, if it's a first-time buyer, you're probably paying some X amount of rent, right? And that's evidently has been higher than it was in the previous time. And so the general rule of thumb that I'm telling everybody is, look, if you're planning to be in an area for a couple of years, like the Bay Area for a couple of years, then it makes sense to be buying something within your means. And your means is your own subjective thing, right? That's I don't control what your means are. You can run the numbers internally of what you're comfortable with. That's number one. Number two, the key is interest rates are higher. They're higher than a artificially low number that we've had for a long time. Now, it's also important to have perspective. Just because interest rates increase by 1 or 2% doesn't mean all of a sudden you can't buy a home. That's not how it works. Yes, you can afford less than it was before, but if you're able to afford $1 million home, it doesn't mean you just now all of a sudden you afford a $200,000 home, right? So this notion of a 2% increase in the last 3 months that all of a sudden people can't buy a house is more of a mental thing, to be very clear, than anything else. Yes, it is much higher than we have experienced for a long time. But that's why there's other products that you can go into, right? Like either the big banks, their 30-year fixed rates are lower than what I've advertised, number one. Number two, you can also go with an adjustable rate mortgage products, which are locking you in for a 5 or 7 year or 10-year term. And that's usually about 0.5 to 1% lower than what 30-year fixes are. All right, so depending on your situation, those are your other options to see what you can buy up to and get. And then you actively then search, okay, well, realistically, where are your options for that? Is it a condo in Palo Alto? Is it a townhome in Fremont, right? You start exploring it from there. And so that's the strategies that I'm telling every one of my buyers right now that are in that situation. And so that hopefully that'll give you some clarity of it, because the reality is no one knows exactly when the bottom is, and you will not know when the bottom is either until it rebounded up, which is not a good thing either, right? And so we understand the situation that we have ahead of us right now, which is right now there's less buyers than there were before. There's opportunity to buy things at even a further discount than what's being advertised, and then we do the best with that search and that situation.
Perfect. Thank you so much. That really helped.
You're welcome. And I'll have this recorded. This is recorded. I'll likely post it on my own YouTube channel too, and I'll send it to Kelvin. You guys can post it too. So a lot of the good information, because a lot of the beginning of the presentation was really about the data, what's actually happening, cutting out all the kind of fluff and news out there that are just very polarizing. And then, of course, at the end of the day, it's an individual decision of what makes sense for themselves and their family.
Sanjay here. Basically, I have two questions. So one is, do you have some data whether single family house versus townhome versus condo, which one appreciates more?
Great question. So historically, single family has done better than both condos and townhomes. Why is that? We can fundamentally just think of many reasons why. Number one, look at the Bay Area. How many single families, at least with yards, we're not talking about those single family that are 4,000 square foot lots, those are different, with a yard has been built just in the last decade? Extremely little, unless you're moving like really far out, whether you're in Gilroy, whether you're like San Ramon, like even San Ramon would be tight, but like unless you're really far out. But in the core Bay Area, Peninsula, San Francisco, Santa Clara County, the more expensive areas, how many has been built? The reality is almost none.
Yeah.
And then what else has happened? Look at what has been going on with zoning changes, right? With California. California will continue to push zoning things that are being more favorable for landowners. So initially it was the state bill related in-law units. They wanted to make it much easier, and they have made it much easier to get the permits and process to build in-laws. What happened earlier this year? You can split lots. So what does that mean? Those people that had those big lots, 8,000, 10,000 square foot lots, are worth a lot more because the valuation of that property is now a different metric. What else are they doing? They're allowing potentially you can tear it down, build multifamily on it, right? Over time, because of what we have, because even if you had the money, if you have $100 million and I say you're a builder, find a place to build in San Mateo County. The reality is it's not that easy to even find a spot for where there's actually buildable area. So it's not even it's just there's no land. You have to tear something down. You have to rezone, redo space to even have that opportunity, right? And so because of that, the state has no choice but to keep pushing it from a state level, these different types of initiatives and these different things. And so the value of land continues to be more and more. That's kind of just the element of that. Now, if you look at the supply side of things, condos and townhomes, they're still being built, right? You'll have more and more condos and townhomes being built. It's not like it's a massive, so it depends on the area too, but you just straight up have more properties and more opportunities to buy it. Look at Communications Hills, look at Milpitas, look at Berryessa, look at Fremont. Those are just a core area. Never mind, look at Dublin, and you have a ton like of condos and townhomes there. But even those areas that are more closer to these prime areas and where the jobs are, they still are able to keep building. That's the product, if they were able to build on land, that they're going to keep building on. So because of the supply of that will impact resale. But to be fair, those are going to be the most expensive condos and townhomes being built. Take a look at Apex and Santa Clara if you have a chance. You know, 1 bedroom, 2 bedrooms are still over $1.2, $1.3 million. So they're not like cheap condos being built, but they will still have some pressure of how much it can grow for all of those reasons. So if one is able to, especially in a good area, it's historically has been better to buy a single family place. Now there will be trade-offs. It'll be maybe older, it may be further than you may like versus a condo or townhome. But historically, they have done better for all those reasons that I brought up.
Thanks, Spencer. So my second question is related to lender. But as you mentioned that your partner works for the lender, so I hope you will have the fair idea to share. So if I am targeting to buy up to 1 million property and I want to put only 5%, that is 50K.
Right.
And what are the options so that I can avoid the mortgage insurance?
So good question. People have a pretty bad rap of mortgage insurance for whatever their own personal reason is, whether it's an extra cost, whether it's a stigma of it, many reasons. It's also important to understand this. If it wasn't for a program like mortgage insurance to exist, you would have had to wait much longer to be able to even buy a place. Right? You may have, let's say, if all the banks were saying you have a minimum 10%, 15%, 20%, whatever the metric is, it's going to take you quite a bit longer to save to get to that number. So there's a component of that, right? That's very mindful to see. It's also people forget you have very little skin in the game. Like, why is there mortgage insurance? The mortgage insurance idea is because they know, look, if the market declined by 5% or by 10%, you're already underwater. So the risk is significantly more on the lender side than it is on your side, right? And so those are like the components of that. Now, it's your choice. I don't usually say, look, because the mortgage insurance for that dollar amount for that purchase, maybe, I don't know, a couple $100 or something, maybe arguably, I mean, less than your HOA that it would be for a condo townhome. So I don't usually say like it's a good or bad thing per se, but I would say it's just a cost that there is to allow you to even have the opportunity to get in much earlier. Because if you just do the basic math, right, like if you had to wait an extra year of savings to save up to 10% or whatever it is, you're paying an extra year of rent. That's something to be mindful of, right? And who knows what happens with prices, whether they go up and down. The story too with mortgage insurance is that there's many ways to exit it, whether it's a refinance or there's different programs in place. But those are also things that they don't last forever, is how it's set up, right? And so there's many ways to exit it. So I'll give a story. Like I have a client that they're in the 20s and they bought, I think, a year and a half or 2 years ago. Great couple, new people. They knew that they want to start paying rent as soon as possible. So they're like, all right, I want to get into place. I want to buy with low money down, which is 5%, and I want to buy up to X. And so they have two options. The option one is they keep waiting and saving to try to get to avoid PMI, which is mortgage insurance, or they can say, look, we're going to get into it now. We're going to start saving. We can accelerate our payoff if we wanted to really save from that. But what also happened was, fortunately, and generally the case over a long period, is their equity just went up significantly. So they got out PMI just naturally without having put any more money. So a combination of like they were able to exit it just naturally, number one. And number two, it's just a whole lot more expensive to now buy that same home today than it was when it was 2 years ago, right? So there's always all those components. If they had waited an extra year or two, they would have been priced out for this new home. And so those are all the aspects to consider, is like, just bake it into your overall cost structure. It's a monthly amount, just like anything else. Are you okay with that monthly amount? If you are, then go for it. If you're not, then they're not. Then adjust, the purchasing power that you have. Look at it as total than a stigma. Oh, I'm not going to do it by principle. Like those are all very, very important just understandings to have when it comes to something like that, something like mortgage insurance.
Actually, I heard there are two types of loan. One is conformance loan and one is jumbo loan. And jumbo loan, if you go, then you don't need to take the mortgage insurance. But if you go with conformance loan, and if it is less than 20% down payment, then we have to go for mortgage insurance.
It's a lot more nuanced than that, right? Why is it more nuanced? Is because it all depends on specific lenders. There's many ways to wrap things up, right? Because as I just brought up, it's all by your monthly amount. A
Yeah.
lender can also structure that into the loan too, right? If
Yeah.
you're paying an extra $200 or your interest rate is at 5% with this setup, why don't I just charge you 5.5% and I just bake that in? Right. So it's not as simple as that. And that's why you have a conversation with, like, my wife works at a mortgage broker. So mortgage broker actually is more beneficial for these situations where you're trying to explore like all these different types. A big bank is harder. You have to go with many different individual big banks to try to figure out, like, do they even have a viable option for that? So historically, the big banks have been very strong at very vanilla files, high money down, maybe jumbo loans, especially in the Bay Area. That's the bread and butter. But with more flexibility than the mortgage broker world, there will be higher rates, but they have more options and they can play around with these different scenarios, right? So it's actually a little bit more nuanced than just that blanket statement, because it also goes down to the individual investor or lender in the back end of how they structure it.
Thanks a lot, Spencer.
Of course, Shashank, do you have a question? You have your hand raised.
Yeah. My question is like, considering like 2 paychecks or 1 paycheck, right? What is the general idea on what should the mortgage be? Like, what percentage of your paycheck should the mortgage be?
The reality is this: housing has become more and more expensive, and it's with both sides, rents and owning a home. If you were to ask people before, of like when people did like rent checks, I rented out one of my homes, and you ask like, oh, I want 3x, 3.5 times income or whatever it is. The fact is, people are just getting more squeezed, and it's a very challenging thing, but it's also the reality. So the question is not of what's the amount. The bank will give you about 43% debt to income. Some banks will give you even higher than that. They can go 50%. It just depends on the specific lender. Now, the 43% is the kind of the flat line across the board for most of the big banks. So it gives you an idea what the bank is willing to lend, which, to be fair, most times, most aren't going to be pushing that for their own comfort and also other expenses that they may have to deal with, right? So there is no rule of thumb, to be fair, because there's no rule of thumb, and it's not good to just have a rule of thumb, because then that doesn't impact like how you live, how much you want to reinvest into the home versus other things, other obligations that you may have. The key is more of what I like to tell people is, look, you should have a comfortable monthly amount. You shouldn't be like stressed and barely make payments every month. That'd be very bad. And to be fair, especially with where we're at, you should always have a nice buffer, right? Have some runway, 6 months reserves or whatever it may be, 1 year reserve. That's also subjective. Have runway that if you lose your job for whatever reason, you can still pay off that entire amount. So that gives you time to find a new one. Most don't give you that. And I'm not a financial advisor, to be fair, but for personally, this just for your own sanity, I don't think it's a bad idea to have runway in case a job is lost. But the exact amount, it ranges, right? I mean, certainly there's people that go to the max, but to be fair, most people in the Bay Area are a lot more conservative than most people in the country. And so it tends to be a whole lot less than that.
Okay, perfect. Thank you.
Also,
You mean the 43% on the gross salary what one is fetching per month, not after tax, right?
it's gross. The lenders will look at gross, 43% of gross, not
So-
after taxes, yes.
So per month EMI should not go more than that, excluding the taxes, which can go yearly.
No, they will bake that all in,
Okay.
right? Because property taxes is you have to pay property tax of it, so they'll bake that in.
Thank you.
Yeah, and as I mentioned, some lenders can be more aggressive and push that, and that's up to the individual if they're comfortable with that. All right, great questions at the end. Appreciate it all. We're wrapping up at 6 o'clock now. So as I mentioned, this will be recorded. Of course, if there's anyone else that was unable to attend this, then feel free to share it with them after. Once again, these are my contact details. I'm going to send a note to the people that have registered, and I really appreciate your time on this. Of course, if you want to set up a strategy call for you individually of your options and where to consider, just call or send me a text, and we can certainly get that scheduled and go over a game plan for yourself. If obviously you're not working with anybody, then I would love to be your trusted realtor of choice. I hope this was very valuable, and without further ado, thank you again for the opportunity.